Hello, everybody, and welcome to the Multifamily Man podcast powered by Total Wealth Academy. Thank you for joining today. Today, I wanted to talk about crappy deals. Don't do them. Okay, thank you, everybody, for joining. It's been great. See, no, just kidding. Um, Crappy deals, right? And what is a crappy deal? How to avoid crappy deals. And this is twofold. This is for people who are looking to raise money, be a syndicator or in partnerships, or for people who are looking to just invest in syndications. Now, may not make I just say some people may not agree with my stance on it and what I believe. But this, again, all is just my opinion. Uh, do your Google searches, listen to some other people, if you don't agree, see what the other opinions are out there. But one big thing that I'm seeing from a lot of syndicators, um, large syndicators, small syndicators, medium, some that are just local markets, some that are nationwide, right, in several markets, is IRRs of like 12%, 15%. Um, Bro, that like an IR of 12% or 15% is nothing. Okay, nothing. That's a bad deal, in my opinion. That's a bad deal. Anything that goes wrong in that deal wipes out everything. Um, and something always goes wrong, right? So the reason that I say that, even though that's very common, and you see them by even some of the biggest funds and biggest syndicators in the world, actually. Um, a lot of times, what you're looking at there is Lucas cut that part out. And the reason I say that's a bad deal is simply because everything has to go right. And again, like I said, anything that can't go wrong will go wrong. Um, you have to look at and for anybody that doesn't know, I'm sorry, IRR. Um, Sometimes I forget some of these terms. Everybody does not know. I apologize for that. Is the internal rate of return, and what that means is it's the return once you include the cash flow, the appreciation, and the mortgage pay down. Some people also add the inflation into that. That is like a super duper calculation, right? And but at the same time, I think adding inflation is kind of guesswork because we don't know what it is. For instance, like inflation last year is a lot higher than it was for the last two previous years. So some people do that, but I always look at it as cash flow, appreciation, and mortgage pay down. That is what gives you your IRR. But if you come out to a deal and you see a 12%, 15%, 12% to a 20% IR, in my opinion, is a risky deal. So be very wary of those. When you look at it yourself, if you're just doing it for yourself, you should want minimum 25% IR, ideally 30 plus. Especially if you're raising money. Like if you're raising money, your IRR needs to definitely be over 30. And you see a lot of syndications where or syndications or partnerships where they're giving away so much equity in the project. If you have to, and this is again, if you're doing this yourself, if you have to give away 70, 75, 80% of the equity in the investment to get a double digit return, it is a bad deal. It's a bad deal. If I have to give somebody 80%, 80%, if I have to give that to them simply to give them a 12% IRR or 15% IRR or even a 20% IRR, that's not a good deal, man. Like, you should be looking at a 50%, maybe 6. At 50%, they should be hitting. If you gave away 50%, right? If the equity that you gave away is 50%, they should be seeing double digits at 50%. Like that it should be at that point, 45 to 50. That's what a good deal looks like. If you have to damn near give it all away to give somebody a 12% return, no. It's a bad deal. So when you're looking at these things, especially if you're not raising money and you get a 15%, 20% IRR off of your own personal funds, or your own personal investments, I think that's solid. I think that's cool for an individual. Um, Not good for me, but for an individual, I can understand. But once you bring in partners who are looking for a good return, you better be at 30% IRR. You better be, right? And in this game, in the real estate game, that's nothing, right? So that's why I'm kind of perplexed, and I wanted to talk to people about it because you see in so many deals where they're only 12%, 15%, when in reality, we have syndicators that we work with here at Total Wealth Academy who are doing 300% IRR. One of our syndicators, 96% IRR in 9 months. Crazy, right? But it's not crazy because in reality, people who really are finding good deals and doing this thing right, those are the kind of returns that they're getting and the kind of returns that they're offering to investors. So you want to be in that boat. Like, they say don't follow the crowd. Like, that's the crowd you want to follow. It's going to be a smaller crowd, but that's the crowd you want to follow, right? If and it's almost kind of like the Warren Buffett method. If when everybody's selling, you should be buying. When everybody's buying, you should be selling. So if you see everybody going after these marginal deals and you see a few people over here doing something different and they're getting extraordinary returns, follow them, watch them, invest in them, right? Don't invest over there where there's not a lot of room, right? Or there's no upside. Again, so that was just something that has stuck out to me because I just noticed it kind of probably maybe 3 or 4 times as many deals coming through because these deals are going to come on the market, especially as people start evicting. And once the memorandums pass up or expire, they start evicting. A lot of these owners are going to be on the hook, and be in a bad spot. So you're going to start seeing a lot more deals coming. And I think it's just the beginning of that. I think that's the effect of why I'm seeing so many deals. But so many of them are shitty. So keep your eye out on that, guys. Make sure that the IRR is at least 25%. If you're going to be investing in the syndication, make sure that, and what a syndication is, or a syndicator, is a person that puts the deal together and they raise money to buy the deal, right, or invest in the deal. That's probably what my next show should be on because that's like master. You can get a doctorate in syndication alone. Like, that gets really deep. But that's just a general idea of what they do, right? It's a little bit more than that, but that's a brief overview of what they do. So if you're working with this syndicator, anybody raising money, it needs to be at least a 25% IRR. And if it's not, just say no thank you, right? Yeah. I mean, that's it for today. Oh, Lucas, definitely don't put that in. So it definitely, if it's not at least 25%, ideally 30% or more, me personally, I believe that's a deal that you definitely should just pass on and kind of wait and wait for those good deals to come. And you're going to see, and we're going to see a lot more good deals as time goes on because the market is still, we're in cycles, right? We're going to see a flood of people who are in foreclosure, single family residents and multifamily and commercial in general, just the effects of COVID, right? So we're going to see it, and there's going to be more deals coming. And always remember, the last piece of advice for today, always remember, no deal is better than a bad deal. So don't do a bad deal. Don't do a marginal deal just because you want to do a deal so bad. Be patient. Wait for the good deal. Wait for the right deal. And when it comes, take action. Don't overanalyze. Don't get analysis paralysis. Don't overthink it, because by the time you go to pull the trigger, it's over, right? So be patient. Wait for those good deals. And when those good deals come, take massive action. Get in on the good returns and be happy, right? But that's it for today, guys. Again, thank you for joining me. Again, this is the Multifamily Man podcast, followed by this is the total. What? This is the Multifamily Man podcast. Damn. Take 3. Again, thank you for joining us today. Thank you for joining me today. This is the Multifamily podcast, powered by Total Wealth Academy. My name is Angela Webb. See you next time.